You might ask the question, why do banks sell non-performing notes? Okay. One is that for every dollar in defaulted notes, the banks are required to hold $7, at least $7 in cash reserves. Okay? So if they've got $1 million, just use round numbers. If they've got $1 million in default, non-paying notes, the unpaid balance of $1 million, they've got to set aside $7 million in cash. Okay? What does that do to the bank? That means they got $7 million less that they can lend to you and I and others to earn money on. Okay? So their goal is to try to reduce the amount of bad paper they've got in order to free up that capital so they can turn around and lend it out. So that's in the process of cleaning up their books. The other thing is it keeps the FDIC off their back, who's constantly looking for banks whose ratios fall below a certain amount. And then what will happen is that they'll seize that bank and sell that bank's assets to a stronger bank. Okay, next.
I did.
Yes?
Is that for all money that's lent out or just for loans that are not performing?
It's for any paper that they have out.
Any paper that-
Yeah, credit cards, auto loans, mortgages, bridge loan, whatever it might be. That's one of the reasons why credit became so tight as we went deeper into the Great Recession. Is banks didn't want to add more to their defaulted. Okay, so it helps them clean up their financial books, and they begin looking better to their stockholders. Okay. We mentioned it earlier. Banks are not in the real estate management business. When you think about it, how much does it cost if you buy a property for a fix and flip? What are your carrying costs for that property? Typically, I mean, you got
Yep.
insurance, you got taxes. You got
Utilities.
you got the lost interest you would have if you kept that money in the bank. Okay, so on a typical flip, it might be $8,000 or $9,000, right? Okay. Now, if you're a bank and you've got a team of people that are processing bad paper and having to go out and inspect the properties and make sure they're secure and so on, how much do you think it costs them to process? $45,000, $50,000, $60,000 a piece. Okay, so loss mitigation and property management is REO processing is a loss center for them. There's no profit in it. So banks are not in the business to lose money, and then when they're losing money to lose money, then that's not a good place to be. Okay, they're in the business to lend money and to collect that money back with interest. Okay. Regulations drive foreclosure costs at banks sky high. The regulations are how long is it if they're going to foreclose, or even before they foreclose, they're required through the CFPB, the Consumer
Board.
Finance Protection Bureau, and Dodd-Frank and so forth. They're required to try to get the borrower to repay and come up with a way for them to get back and start paying again. Okay? So if the bank has 1,000 loans that are supposed to be paying $1,000 a month, and every month that goes by, how much are they losing? Okay, so that begins to add up, and there's a lot of pressure. So what they want to do is they want to get out of doing that. Okay, let's back up one slide, and I want to finish this idea here. So banks got a huge black eye back in 2007, 2008 because they were doing their own foreclosures, literally thousands of them, and because of the huge volume, of course they made mistakes. And sometimes they would go and they would foreclose on Mr. and Mrs. Smith, who had never missed a payment in 15 years of making payments on that particular mortgage. But they'd slam those things through, and that really got a lot of people upset, so they're trying to change the rules. So the bank said, we don't like to have the bad press of foreclosing on Mr. and Mrs. Smith. So what can we do? What we'll do is we'll sell that paper to a hedge fund and let them deal with it. Let them go through the process of trying to get people to repay and reperform and so on. And the reason it works is that banks really can't accept any losses other than when they sell the note. And they take reserves and it looks good on their books when they do that. But once we buy it as an investor, we have a lot of flexibility because we're buying the debt at a steep discount. Okay? So now we have the opportunity to work with the borrower to try to get them to reperform. We can do things like lower their interest rate, and particularly if it's up around 8 or 9 or 10%. We can defer some of the arrearages. If we can get them to perform, we can use that as a carrot, if you will, to say, if you make 6 months worth of payments, we'll take and forgive half of your arrearages, which could be $35,000 or $40,000, a significant barrier to them getting back on their feet and being able to move forward. They paid at the top of the market $100,000 for a property that's only worth $60,000 today. We have the room to make a very nice profit and reduce the amount that they owe down much closer to where the real value of the property is, giving them security. Okay? And we bring them a lot of help and security, and that gives them a significant incentive to go ahead and continue making their payments.